Welcome to the SA Residential Rep, your monthly view on what's actually moving in South Africa's residential property market. I'm Sarah, joined as always by David. February 2026 was a genuinely extraordinary month, not just for the headlines, but for what the data is telling us about where this market is structurally heading.
On the 16th of February 2026, the South African Reserve Bank published a consultation paper proposing to abolish the prime lending rate, the number printed on every home loan agreement in this country since 2001. 12 million contracts, 3.2 trillion rand, and nobody saw it coming.
Today, we're covering the full month, the MPC decision, the sentiment picture, what Two-Pot is quietly doing to the first-time buyer market, the budget pre-read, and that prime bombshell David just teased. A lot to get through. Let's go.
But before we do, we must tell you about Can Do World and why this podcast is so special for another reason. It's our first.
Yes, we are excited to bring you the Residential Wrap. This will be an ongoing series of weekly, maybe more often, updates of the residential sector in South Africa. We will cover macroeconomic drivers as well as follow the important stories in this vibrant sector.
And when we say residential, we mean it broadly. Buy to rent, student accommodation, build to sell, and retirement accommodation. Basically everything residential where people live.
David and I are a bit special as well. We are AI voices created by Can Do World. Can Do World bridges the gap between real estate and artificial intelligence and was founded by Len van Niekerk with some 25 years of experience in the real estate sector. And yes, Len keeps a very close eye on us.
But there are some limitations.
Yes, because we are AI, we might not always get our pronunciation correct. Smile along at some of our pronunciations.
We don't want to give the full game away, but we will be covering more than the residential sector, but are kicking off here with the Residential Wrap series. Let's go.
David, set the rate environment for us.
Prime sits at 10.25%, repo at 6.75%. The MPC voted to hold at its January meeting, but it was a 4-2 split, which matters. 2 members wanted a 25 basis point cut. That minority view tells you the internal debate is live, not settled.
And the forward path?
2 lanes. The SARB's own quarterly projection model has repo landing at 6.31% by end of 2026. That's the structural floor, the conservative baseline. Market consensus, including Goldman Sachs, is projecting 6.2 to 6.25% by Q3. For the residential audience, that translates to a prime terminal range of approximately 9.50 to 9.75%, 50 to 75 basis points of further easing from here. The headline CPI print came in at 3.6%, well inside the new fixed 3% target band. And this is where it gets interesting. The real rate, repo minus CPI, is significantly positive. That restrictive premium is the structural anchor that prevents the sentiment recovery from becoming a full-scale boom.
So we're not at the races yet?
Not yet. The gun is loaded, but the SARB's hand is on the safety.
Because the demand side is telling a very different story. The Absa Homeowner Sentiment Index hit 87% nationally in Q4 2025, a 10-year high. The FNB Property Barometer has agent confidence at 75% nationally. Mortgage originators are describing these as the best buying conditions since 2020.
And the demographic breakdown of that confidence is the real story. Under 35 buyers, 91% confidence. The 35 to 44 cohort, 89%. Under 44 buyers now account for approximately half of all residential transactions. These are buyers who have looked at the rate trajectory and made a deliberate timing call. Get in before the cuts drive prices up.
The first-time buyer surge is real. Women now represent more than 50% of first-time buyers nationally, and the Better Bond data showed a 44% year-on-year surge in applications above 3 million rand. Luxury demand is accelerating ahead of rate cuts, not after them.
But the stratification is stark. Upper mid-market, 2.6 million to 3.6 million rand, sentiment at 88%, average selling time around 10.5 weeks. Luxury above 3.6 million rand, 85%, selling in just over 10 weeks. The affordable segment below 750,000 rand, 66% sentiment, 13 weeks plus. That bifurcation between the top and the bottom of the market is not a transitional feature, it's structural.
And there's a two-pot angle here that doesn't get enough attention.
Right. What the data from February is suggesting is that two-pot withdrawal activity in late 2025 has been functioning quietly as a shadow deposit mechanism. Buyers in the 800,000 to 1.5 million rand band are showing up with deposits that are partially sourced from their savings component withdrawals. It's acting as a price floor in that segment because it's unlocking buyers who previously couldn't bridge the deposit gap.
Which is brilliant until the withdrawal runway runs out.
Exactly. The two-pot stimulus is already expected to fade materially by late 2026. If you're a developer with a project targeting that bracket and you're modeling 2026 second-half volumes, you need to price that fade into your assumptions.
Let's talk about institutional capital, because February gave us a very concrete proof point for the thesis we've been developing. Discovery announced the acquisition of its new headquarters from Growthpoint, a transaction valued at 4.05 billion rand, Sandton, prime corporate infrastructure. And David, this is almost textbook island strategy.
It's the thesis made flesh. What the island strategy says is that in a market with uneven municipal infrastructure, governance reliability and service delivery, sophisticated capital concentrates in geographic and sectoral nodes that can sustain their own reliability, what we've been calling islands. A 4.05 billion rand acquisition of a Sandton corporate campus by a company that can afford to go anywhere is a vote for that node's structural defensibility.
And it's not isolated. The KZN North Coast has 75 billion rand in investment pledges. Westtown, the Shongweni development, which is being positioned as a potential city of the West, is a private infrastructure-led urban island being assembled outside traditional municipal delivery. These aren't coincidences.
The fortressing data supports this. 82% of existing homeowners surveyed in February reported investing in their existing assets, perimeter security, solar, water storage. They're not moving, they're upgrading their island in place. That's a separate demand driver for the renovation and maintenance economy, but it also tells you something about confidence in long-run residential stability within certain nodes.
The question for buyers is which nodes qualify as islands, because not all of Gauteng is Sandton, and not all of the Western Cape is the Atlantic seaboard.
Tshwane is genuinely interesting in this context. It's been the quiet outperformer. Lower price points, better relative municipal reliability in certain suburbs, and Pretoria East is showing transactional velocity that's outperforming the Johannesburg average. It's an island within Gauteng that the headline data tends to obscure.
The national budget lands on the 25th of February. The property market is watching two things specifically. First, will there be a CGT adjustment? The effective CGT rate has been creeping up. The primary residence exclusion hasn't moved in years, while the inclusion rate has inched upward. The second is bracket creep, and this is the silent killer of the middle market recovery. The 1.2 to 2.5 million rand buyer base lives on salaries that bracket creep is quietly eroding in real terms.
Finance Minister Gorongwana is expected to maintain fiscal consolidation. Major tax hikes are unlikely this close to municipal elections, but bracket creep doesn't require a tax hike. It operates passively as nominal wages fail to keep pace with inflationary bracket movement. The effective income compression on the suburban buyer driving current transaction volumes is real, and it's cumulative.
And on supply, this is the constraint that keeps getting underweighted. National residential building plans passed are running approximately 45% below their 2018 peak. The supply pipeline is materially impaired. Right now, the market is running on demand recovery against a constrained supply base, which supports prices. But real wealth-generating capital growth, the kind that outpaces inflation over a full cycle, that's likely delayed to 2027 while the pipeline recovers.
The Orca auction data is a useful signal here. 2.6 billion rand in auction sales in February, a record. When auction volumes surge, you're seeing both distressed disposal and opportunistic acquisition. The foreclosure story is a separate thread. There's a 60 billion rand home foreclosure class action working through the courts, targeting banks' administration fee practices. That's not a property market story yet, but if it moves, it's a mortgage market story. I want to stay on the prime rate reform because I don't think the market has fully digested what was published on the 16th of February. The SARB released a consultation paper proposing to abolish prime as a benchmark no earlier than 2027. 12 million contracts, approximately 3.2 trillion rand in exposure, with mortgages representing roughly one-third of that.
For listeners, prime is the number your bank quotes you when you get a home loan. Prime minus 0.5%, prime plus 1. It has been mathematically fixed at repo plus 350 basis points since 2001. It's not a market rate, it's a policy spread. What the SARB is proposing is to replace it with direct repo rate plus margin pricing, where banks compete on their individual risk spread above the policy rate.
Which sounds like better price transparency, and it might be. The JBAR to Zarionia transition for short-term instruments is already underway and expected to complete by end 2026. This is the next logical step. But here's the tension. Will banks use the transition to genuinely compete on margin, or will the individual risk spread simply replicate the existing prime spread under a different label, just harder for consumers to benchmark?
And there's a deeper question for existing borrowers. The fallback spread mechanism for legacy contracts is supposed to prevent legal disruption, but 12 million contracts on prime-linked pricing have been structured on the assumption of that fixed 350 basis point spread. If the transition introduces even marginal uncertainty into that assumption, analysts and mortgage portfolio managers are going to need to reprice the entire residential yield curve ahead of 2027.
This is a 25-year inflection point for how mortgage credit is priced in South Africa. Whether it ends up being a consumer win or a sophisticated repricing exercise that benefits the banks, that question is genuinely open, and the SARB's consultation window is the moment for the market to weigh in.
February 2026 delivered one of the highest sentiment readings in a decade, a demographic of buyers making strategic timing calls ahead of the rate cycle, and institutional capital moving into nodes that fit the island thesis. But it also delivered a reform proposal that could reshape the pricing mechanisms of every home loan in the country. The intersection of those two things, optimism at the headline level, structural repricing below the surface, is exactly where this market is operating. Next month, the national budget outcome, the March MPC decision, and whether the Cape Town General Valuation Objection window produces the pushback the market expects. Watch those three. Thank you for listening to the SA Residential Wrap.